Imagine handing your life savings over to the most respected man in finance. He promises a perfectly steady, risk-free 10% return year after year. You trust him completely, unaware that behind the heavy vault doors of his firm lies a dark abyss. In 1960, Bernie Madoff took $5,000 he saved from working as a lifeguard and started his own firm. Over the next few decades, he helped pioneer the electronic trading systems that brought Wall Street into the modern age. His rise culminated in immense institutional power. He eventually served as the chairman of the NASDAQ stock market, cementing his status as financial royalty. Yet that entire empire was a $64 billion lie. It was the largest Ponzi scheme in human history. The most baffling aspect of this crime is how long it lasted. Federal authorities received explicit, detailed warnings that he was lying, and they actively chose to walk away. Madoff evaded capture for decades. His scam lacked technical brilliance, but his institutional myth provided an absolute psychological armor that deflected all scrutiny. This illustrates his split-strike conversion. He claimed he bought top-tier stocks, shielded by options contracts. The reality? No trades were made. Investor capital bypassed the market, deposited straight into a Chase account. He ran a Ponzi scheme, paying old investors with new investor cash. To maintain this illusion for auditors and clients, Madoff's team used computer software to generate thousands of fake paper trade confirmations, intentionally backdating them to match historical market prices. If clients asked probing questions about the lack of live market data, Madoff threatened to kick them out of the fund. By strictly enforcing this velvet rope exclusivity, he replaced verifiable math with social proof. In 1999, a financial investigator named Markopolos decided to reverse engineer Madoff's flawless track record. When Markopolos ran the numbers, the math broke. There simply was not enough volume in the options market to support the massive trades Madoff claimed to be making. Earning those perfectly steady returns legally was mathematically impossible. Markopolos escalated his findings repeatedly. By 2005, he sent a detailed submission to the Securities and Exchange Commission with a title that left no room for interpretation. The world's largest hedge fund is a fraud. Raw empirical data collided directly with Wall Street prestige, and the institutions paralyzed themselves. The myth continuously defeated the math. The SEC's response to Markopolos was incompetent. They conducted brief, superficial reviews of the firm, accepted Madoff's explanations without verification, and closed their investigations. Regulators suffered from a severe bias. They looked at a man who sat on their own advisory committees and viewed him as far too deeply connected to be a criminal. Agencies struggle to police fraud when the perpetrator is embedded at the highest levels of the regulatory infrastructure itself. A mechanical fraud of this design survives on two non-negotiable variables: a constant influx of new cash and a low rate of investor withdrawals. In late 2008, the global financial crisis struck. Credit markets froze, banks collapsed, and panicked investors desperately liquidated their assets to find cash. In November of that year, Madoff's clients demanded $6 billion in redemptions. He only possessed a fraction of that amount in the Chase account. A severe macroeconomic stress test instantly shatters localized financial illusions. The systemic math of a crashing market outlasts the personal myth of the operator. On December 10, 2008, a cornered Bernie Madoff confessed to his sons in his Manhattan penthouse. Federal authorities arrested him the very next morning. The ensuing damage hit 37,000 victims across the globe. It destroyed the wealth of elite Hollywood figures, gutted university endowments, and erased the life savings of everyday retirees. These side-by-side charts reveal the staggering scale of the theft. Madoff stole roughly $17.5 billion in real, deposited principal, but because of his fabricated statements, clients believed they had $64 billion in paper wealth. That money simply vanished. Madoff pleaded guilty and received a maximum 150-year prison sentence. The tragedy escalated when several ruined investors committed suicide, a fate shared by Madoff's own eldest son. Prestige can never replace due diligence. As we look back at the devastation, a difficult question remains: who holds more blame? The regulatory watchdogs who fell asleep, or the human greed that chose blind trust over basic math.